Well, greetings everybody, and welcome to the July 2019 session of the Roundtable. This is our 9th anniversary or birthday celebration, so we're going to be a little bit festive here tonight. We'll have some fun doing this. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by my beloved colleagues, Cy Lynch from Atlanta, Hugh McManus from Pasadena, Ken Kavula from mid-Michigan, and Kim Butcher from Evansville, but she's spending an awful lot of time down in Florida. Greetings, everybody.
Hello, everybody. Glad to be here this evening.
Good evening.
Hi, everyone.
It's been a great 9 years. We're going to go over that here in a few minutes, but it really is kind of cool. We kind of joked about doing this 9 years ago. Ken said no costumes, so we kind of avoid the costumes, although I stuck some on there tonight. Sometimes we go with hats, but this really is about fun and sharing of ideas. So let's go ahead and get underway because we have a boatload of slides here tonight to go into, and we'll have to be diligent to get through it all. First of all, the legal paperwork. No investment recommendation whatsoever is intended. This is all about education. It's about demonstrating the philosophies and practices and methods of the modern investment club movement, whether that be as promulgated by NAIC Better Investing or Manifest Investing. It really has to do with individuals and groups of individuals known as investment clubs out there in a never-ending quest to find the best companies at the best prices. And that's what we're here, just basically demonstrating that kind of thing. We will try to tell you if we actually own the companies that we talk about. If you'd like to send, or if you'd like to receive or have a reminder sent to friends or family, send a note to nkavula1@comcast.net. If you have follow-up questions, you can write to me, Mark R. at manifestinvesting.com. You can also request a copy of the slides. Also note, as Ken mentioned in the green room a few minutes ago, we tend to stick around for 15, 20 minutes afterwards, nailing down questions that develop during the session and even some that perhaps erupted before the session tonight. Here's our standing agenda. Again, welcome, particularly if you're a newcomer. We welcome you with a hug and basically say this is informal. The 5 of us will be making individual stock selections. We do keep track of our results. We will visit that for a few minutes. You can see some of the pageantry of the companies that we will be talking about as we go through it here tonight. But we will be starting tonight with a brief celebration of where we've been and what we've done. Here's the reminder that we use every month that this is what it's about. We're here to talk about ideas that we have currently that are actionable, and everybody here knows that actionable means don't call your broker. It means study the stock and decide if it's right for you. Do your own homework. We do allow and, in fact, encourage playful, non-core selections as long as they don't dominate the portfolio, up to 25% of the portfolio. Hugh has one of those tonight again for us. One that we really have great hope for, but we also know that that one might not work out so well, but we have great hope. We do keep track of a tracking portfolio. We'd like to see that tracking portfolio beat the Wilshire 5000 by 5 percentage points over the long term, and we'd like to, for the selections that we make, to outperform mirroring selections in that Wilshire 5000 50 or 60% of the time. Here's a quick look to kind of launch a little bit about where we've been, give you a little bit of background, show you a little bit about how we keep track. The 5 companies up at the top are current active positions in the tracking portfolio, one selection by each of us, and it happens to be the oldest selection any one of the 5 of us may have made. So you see SCI Investments from Ken, Costco from Hugh McManus, Global Payments, that's been a world beater. It's a one-time selection in the portfolio. Wait till you see what it's done. $1,000 invested is now $8,700. I selected Roche Holdings back in January 2011, and Kim selected McGraw-Hill, SPG Global now. And skip all the way over to the right. That's the comparison of how well the companies have done versus the Wilshire 5000. You can see that we're 4 for 5. And I'm not too upset about coming in at minus 1.7 because Roche has been kind of in a bit of a slump. Hugh tells me not to worry about it. But the annualized return over the roughly 8 or 9 years coming in at 10.9 is nothing to sneeze at either. But you can see that those 5 selections have done pretty well. The bottom table are the top performing selections, whether they're active in the portfolio now or the highlighted ones are actually closed out or sold positions. So you can see that we've got some real gangbusters going on at the top between Universal Display and Simulations Plus. The audience has been doing better and better all the time. It's really kind of cool to watch the audience vote. We have an audience vote every month, and you can see that the audience has a couple of those all-time selections up at the top and another one down below. So you can see that there's a number of pretty special performing selections that we've made over the last 9 years. And I do want you to notice the number of 2018s in that chart. Look at the purchase dates and notice how many of those selections were made during 2018. My message to all of us is whatever we were eating for breakfast or whatever we were doing during 2018, we just have to keep doing it. You guys all good with that?
Sure, because probably none of us know, but we did good.
Mark, we do have a question. Can you tell us what the heavy type means in that column with the tickers? The people are noticing that there's 3 stocks with real heavy type. Does that mean anything, or is that just a signal to you for something?
It's basically operator error. Whenever a company is in the round table, I try to bold it so that when I'm looking at the master database, I can just cheat and know that that's a company that's in the round table. So literally when I'm looking at you'll see an example of that later, I think. Everything is bolded. That just means that they're in the round table portfolio.
Okay.
If they're bolded and bright blue, that means they're in the Manifest 40, which is the 40 most widely followed stocks by our people. Okay.
Okay, and we're also getting a question mark of this. This is showing relative return, so that's points above the market, and the market would be different for every single one of these stocks because they were purchased at different dates. Is that correct, Mark?
That's correct, and we're basically looking at what if we take, for example, on that first one at the top, Universal Display, the audience selected it on June 26, 2018. We invested $1,000 into the stock Universal Display, and then we also put $1,000 into the Wilshire 5000 VTSMX mutual fund, and then we tracked the performance of the two. Okay? So
that clears it up, I think. Okay.
This is kind of a fun one. I put this one out on Facebook, and I think, again, just thanks to all of you. Look at everybody showing up on there, including a couple of the guest nights. And by the way, for those of you worried about Kim, she's got several that are just about on that chart, and I think she's our all-time leader, so don't worry about Kim. Here's what that all adds up to. Yeah, she took home all the Golden Knights a year ago. We haven't forgiven her yet from our February celebration. Here's what it all adds up to. And again, over a 9-year track record, we are now coming in at an annualized rate of return of 17.3%. If you put, again, those matching investments into the Wilshire 5000, that checks in at 11.8%. It's been quite a bull market run over the entire lifetime of the Investing Roundtable. We have beaten it by 5.5 percentage points. That's what you see on the graph. And over half of the selections we've made, 50.1%, have actually beaten the Wilshire 5000, which has been no small feat considering how bullish it's been over the last 9 years. So that's an awesome trend, one that we hope to keep in place and keep selecting better companies at better prices. Any questions, Ken?
No, everybody seems to understand what you've shown them so far, Mark.
Okay, I want to keep it short and sweet tonight. We want to end up on this leaderboard. We are on it. As soon as we get to 10 years, we're actually at 9 years at 5.5%. So this is taken from a book that was shared with us by James Clunan at the American Association of Investors. It just goes through and talks about a number of very accomplished investors and how much they beat the market by over how long. And you can see some of our favorites out there with Walter Schloss, Warren Buffett, Joel Greenblatt up at the top, people that we talk about every once in a while and emulate some of their selection methodologies. But we're on the board and hope to stay there. Here's the actual portfolio. These are the top 20 stocks by position size, percent of assets. So Microsoft is the largest position in the portfolio. And basically, we take $1,000 and invest it in any one of these anytime a decision is made by a knight, a damsel, or the audience. So in the case of Cognizant Technology up at the top, you can see that Cognizant has been selected 15 times. Up here, this legend up here. So 15,000 invested into Cognizant is now worth $23,000. That's basically how you can break down that chart. You can see that there's a few two-time selections down there on the bottom of that legend. But from top to bottom, you can see that there's several household community favorites on the list, but there's also some companies that we have discovered together and really had a great time with. Ulta Beauty, by the way, is the top performing stock in the S&P 500 over the last 10 years. And it certainly has been a wonderful part of this portfolio. Any questions or comments from you guys?
Just to remind folks that URL at the very top of the slide will allow them to see the entire portfolio for free. Just type that into your browser and you'll see the entire portfolio, and you'll be able to sort it in different ways if you choose.
Okay, so let's go ahead and press on. You guys can take a look at those. I believe there's 70 active positions, actual stocks in the portfolio right now. Let's talk a little bit about some of them towards the bottom. We think it's a best practice for any investment club or any investor when they sit down with their portfolio to take a look at the weakest return forecasts in their portfolio. What we've done here is taken that dashboard that Ken just pointed out on the previous page and sorted it by the projected annual return from lowest to highest. So subject to audit, the companies at the lowest end are the ones that have the lower return expectations. So those would be candidates for sale considerations, selling studies. And for tonight, what I think I'd like to do is, with Kim's permission, kind of put Western Union on the hot seat. Their growth has been kind of lackluster. She got in, that's a one-time selection, so she's up 54% in it, so the timing was good. But as far as the future, and here I'll just go to a quick look at a visual analysis of the business model. I kind of have a hard time getting as optimistic about the right-hand side of that chart as Value Line does. And I think we can all see that the growth has been kind of sluggish. Everything's quite flat. If you use a sales growth forecast of 1% instead of 5%, you get down at those low single-digit numbers for the return forecast. So again, if you drop this forecast and make it match basically this green line, you end up with a return forecast probably down around 2 or less. Hopefully that's clear to everybody. So that's why I'm basically saying, let's say thank you and walk away from the water cooler, high five, and say, and press on. Any thoughts on that, Kim? Anything that we're missing?
No, kick it to the curb. I did that a long time ago.
Okay. So I thought you'd probably say.
Yeah, because Formula One was mine, and I'd say kick that one to the curb.
Yes, that's what I'm going to recommend, that we basically whittle the portfolio down with those two positions.
Yeah, but I'm keeping S&P Global, and TSS just got bought out by Global Payments.
Right. So all of these merit being continued in the portfolio, in my opinion. Any thoughts on any of those guys?
I agree. Just from a quality standpoint, the bottom three are pretty high quality stocks. The bottom two have some issues with growth, some issues with quality, some issues with earnings stability in one case. So yeah, let's move. That's about 1% of the portfolio. Let's move it to the side.
Yeah, I was going to comment on the quality too. The two that we're selling are both low quality. The other three are, they're not yet to my par. They're below market, but they are high quality. Also notice the low financial strength on those. And the other thing I would look at is Liberty Formula One. To get that 0.3% return, you're seeking a 28 PE. Not saying the 28 PE isn't attainable, but there's not much reward there. So.
Yeah, I think the big takeaway is Kim got into those at very good entry points, and it's a crime not to exit them when you get the opportunity.
Yeah, they were from all the Formula Ones was the spinoff from Liberty Media.
Mm-hmm.
I'm going to make a comment that has nothing to do with this. Hugh, if you're trying to speak, you're appearing muted on my end here. So if you are trying to say something, Hugh, there we go.
Yeah.
I don't know. Were you trying to say something, Hugh? Go on.
No, I wasn't. I was. If I had to say anything, I would defer to Kim, obviously, in the Western Union thing.
Okay.
It looks
All
a little
right,
bit
great.
unhealthy, but that's it.
Okay. Well, as far as the overall portfolio, we'd like to see the return forecast raised a little bit. Average stock is around 8%, as you can see over here on the chart right now. So we'd love to see it up in the 12 to 13 range. Plenty of quality, and it's really kind of cool to see plenty of growth. We want to keep that number robust. So there's the Western Union thing. We don't have any timeouts. No stocks that have been selected during the last year have actually approached the 20 threshold. Of course, I say that, and we'll probably have a few next month once we talk about it. We also don't have any quality degradation candidates tonight to talk about, but I do want to talk about one here, Simulations Plus. It is one of the all-time ones that we saw on that previous slide a few slides ago. It's one of my selections. It was seconded by Cy and also voted by the audience when we selected it. And I just have a concern that it's up there in that range, 80 to 90 on the relative strength. It has been red hot. There's no way to describe it other than that. It's got it's actually ahead of where the optimistic rhinos think it should be 12 months from now. It's already ahead of that. That's what that 111% means. We're going to talk more about that here in a few minutes. But Morningstar sees it as overvalued. So does the analyst consensus. And I want to basically close out my position in Simulation Plus tonight. And I don't know how you feel about it, Cy, but I love this company. It will not leave my radar screen, and I will come back if a suitable opportunity presents itself. But I do think it has kind of superheated a bit.
I have no problems with letting it go. I was just checking because I had noticed it wasn't on the hit list, because actually I thought it was going to be on the hit list, but it looks like you did a data update that must have helped the par slightly.
Right. There was a data, a quarterly update that helped it a little bit. But yeah, it's red hot, and the expectations are also going up. So if we maintain yours, maybe we'll have the audience vote in the Q&A period just by a show of hands what they want to do with their position. And
Mark, I have a small story about Simulations Plus. If you remember, 4 or 5 years ago at convention, I told the story of meeting a former student, and she's a research scientist at University of Michigan, and she had told me about this company, and we presented it to the convention about 4 or 5, maybe even 6 years ago at the stock panel, Let's Talk Stocks. And I saw the student by chance about 2.5, 3 weeks ago, and I told her the very lucrative story of Simulations Plus about how it's leading some of us to top spots in a stock contest with the groundhogs, and how it's doing so well in our portfolio. And she wanted me to inform you and the rest of the knights that she was only going to charge us $100 per share to keep the position going in Simulations Plus. Now, obviously, she has no intention of doing anything, but she was very pleased to hear that her one and only stock pick in her entire life was a real wing zinger. So she was very pleased about that whole thing.
Very cool. All right. So with that, I think we can go ahead and proceed. We can come back during the Q&A to some of the other stuff, but let's go ahead and press on. We've got a tight time frame tonight with Alimentation Couche-Tarde. Go ahead, take it away, Ken.
Okay, I'm getting a little bit more defensive in some of the stocks that I own in my portfolio. I'm not panicking. I'm not selling everything, but when stocks are moving below the par value, especially my par value, that's the average for the Manifest Investing database, and when they're moving below that average, and when I'm looking at a stock that I've made some real good money on, especially if it's in a tax-deferred account, like a lot of my money happens to be sitting right now, I'm not afraid to raise some cash at the moment and then to put it into some things that are a little bit more defensive. I've recently purchased this particular stock, Alimentation Couche-Tarde, obviously French. The Quebec-based company has a ticker ATD. This is Class B stock, and it's traded on the Toronto Stock Exchange, but your broker should have no problem adding this to your portfolio if indeed you should decide to purchase it. For those of you that don't read French, Alimentation Couche-Tarde means food for those who stay up late.
I didn't
That's
know
a
that.
that's a direct translation of what that sentence means right there. And a lot of you maybe know the company by the logos that it carries throughout the world. Its biggest logo is Circle K, and there's a huge number of these stores in the United States, a lot in Canada, and a fair number worldwide. They also have Couche-Tarde stores, and they also have Ingo stores in various parts of the world. So they operate right now under three major brands, although a concerted effort is being made to cluster everything under the one brand name Circle K and to move forward with a single brand. Mark, if you move the slides one for me. They get their revenues mostly in the United States at the present time. You can see that in the left-hand circle. A fair amount in Europe and some in Canada. Very little presence, no presence for that matter in the Middle East or in Asia or South America. The income, the revenues are coming from fuel, from things that you can buy in the convenience store itself, and then from merchandise and service to the automobile. That's the blue section on 54% right there. So lots of profits coming from merchandise and service. It represents only a quarter of the revenue, but it represents over half of the profit coming to the company, and that gives you primarily the major reason why different places operate convenience stores attached to gas stations. Next slide. Here's a snapshot of the population of U.S. convenience stores, and it shows that there's a lot of room in the United States, for example, for a lot more penetration of stores with gasoline pumps, just like Alimentation Couche-Tarde does. Right now, the company that we're talking about only represents about 6% of the market. Notice the blue piece under chain size. That blue piece is basically independents. And so the market's made up of a huge number of independent stores with a few good-sized chains in there that are nationwide, but there's a lot of room for expansion, and that's where a lot of the growth in the United States and in fact worldwide, that's where that growth will come from. Next slide. The convenience store business is amazingly recession resilient. I would like you to tell me where the recessions are in this set of bars right here. The bars represent inside sales, and that's just a strange way of saying anything you sell within the four walls of the convenience store itself. This is excluding stuff at the gas pumps, okay? And you'll notice that during the recessions, the growth continued, and the growth continues outside of the recessions as well. Amazingly resilient when it comes to slowdowns, and that's why I consider it a kind of a defensive stock. Next slide. Alimentation Couche-Tarde makes the point that it's an expert in the sale of age-restricted products. And you'll see those products circled there under the convenience section. A huge amount of the OTP, those are other tobacco products, everything except cigarettes, but a huge section of the other tobacco products are sold in convenience stores. They're not sold in traditional food stores or drug stores or mass merchandisers. A huge portion of all cigarettes that are sold, again, are sold in convenience stores. Alimentation Couche-Tarde just inked a deal with Canopy, and they're going to be serving as a distribution network for marijuana as it rolls out throughout Canada. Remember, it's legal in the entire country, and they're poised to do the same thing if and when cannabis becomes legal throughout the United States. They think that they're ready to deal with these age-restricted products, and they understand how to handle that kind of product through the sales channels that it operates. Next slide, please. Here's a global footprint. They do have a little bit of penetration in places outside of Europe and Canada and the US, but that penetration is through international licenses with other names. Their own brand is not sitting in Mexico or in China or in Saudi Arabia or Egypt, places that you see in gold on this map. Those are the prime candidates for the next growth for this particular company. Next slide. They are an acquisitive company, but they don't grow entirely by acquisition. I am pointing you, however, to the number of stores that they've acquired every year since 2004. And in the most recent full fiscal year, which was 2018, you'll note that they acquired over 2,000 stores to add to their chain. So they're quite acquisitive, and that means that they have a fair amount of debt as they acquire small chains or individual stores, and they've traditionally been able to handle that debt without too much problem. Right now they have over 10,000 stores, and their goal is to double their store count in the next 5 years. Next slide, please. Norway, the stores that they have in Norway, they're using as a laboratory right now. And this kind of busy slide basically says we're going to add electrical charging stations to our entire network of convenience stores, and we're going to try to shake out the problems that occur with these electrical charging stations. We're going to try to work out how the cars can handle getting a charge, how long it will take, what the mechanics are behind it, what kind of extra utility do you have to bring into your locations. And once they get this right in Norway, and it's really working quite well at the moment, then they'll be kind of rolling this out to the rest of Europe and into Canada and the US. But right now, if you have an electrical car, your biggest challenge, I guess, right now is to drive long distances and make sure that you end up with a place that you can charge your car when the charge is getting very small on the vehicle. So Alimentation Couche-Tarde means to be one of the locations where you can count on a charge, and they would like to be at that place in the next 18 months to 2.5 years. Next slide. Their relative stock performance has been stellar. Their stock price is in the blue line. Our S&P is in the red line. And if you make a composite of the US S&P along with the Toronto Stock Exchange, you get the gold line. But either one that you pick, you notice that the stock is doing quite well in relationship to some standard averages. Next slide. Here's the chronicle from Manifest, and it's the first place I look to when I'm deciding whether or not I want to buy a stock. I love that nice boring blue line at the top of the graph. It's horizontal, and I think right now it's at about 89. I think that's a wonderful place for a nice boring quality to be. It's a relatively short history because it's only been in our database for a little bit more than a year and a half, 2 years. So we're gathering the data as we go with quality ratings month by month by month. But if that quality rating should suddenly take a nosedive into lower levels, that would be a signal for me to perhaps want to get rid of this stock, or at least take a deeper dive and find out what the heck is happening. Next slide, please. These are numbers coming from Value Line. I consider 8 to 18% between high and low annualized total return to be fairly decent numbers. That's where Value Line thinks the growth will be in the next 3 to 5 years. Notice that they're estimating sales growth at around 6.5% and earnings growth at around 12.5%. Both fairly healthy numbers. Alimentation Couche-Tarde has had a really good history of taking lower margined stores, buying them up as a chain, and then moving those margins higher as they rework the store, moving in higher margined goods and moving out a lot of lower margined goods. Next slide. Here's the familiar visual analysis from our SSG Plus. I'm saying to myself, for a smallish kind of company, and it's really not that small at 59 billion, but those are pretty decent up, straight, and parallel lines in my mind. A little bit of cyclicality in sales as we go through different pieces of the economy, but for the most part, I think that I have some dependability when it comes to predicting where we're going to go next with the growth in the company. I've set sales growth at around 7 and set earnings growth at around 12 going forward. And again, my expectation is that growth in earnings is going to come from a change as they continue to add stores, from a change in the mix of what they're selling in the convenience side of the business. Next slide. I'm looking at the red at the evaluation of management section from my SSG. Those are excellent margins, by the way, folks, and the margins bump around a little bit, but they're low. They're traditional margins, very similar to what you might find at a grocery store. And I'm feeling good about the fact that the margins peaked, went down, and now they're moving back up again. Those margins today in 2018 can be compared to 10 years ago, and there's a really nice upward trend in my mind for the last 10 years. Moving for the margins. Those are decent return on equity numbers, and they do move around a little bit with debt. And I already explained that the debt to capital is a little bit high because of the acquisition that's being done. This is the second largest company in Canada, and I found that hard to believe, but that's the fact that was put out in their investor materials. And this second largest company in Canada does a really nice job of controlling the amount of debt. It's carried a large amount of debt, if you notice, for the last 10 years. I went to Morningstar, that's the numbers at the bottom of the slide, and looked at interest coverage. When I see numbers above 8 in interest coverage, like I do in the very last line of this slide right here, and when I see that they've been nice and healthy since 2015, I'm not as worried about the size of that debt number as I might be if the interest coverage were down around 2 or 3 or something along those lines. Next slide, please. My results for this SSG suggest a buy at a 4-to-1 upside downside. I like to read the return as a range, so My SSG is saying maybe 11 to around 15% return. That compares quite nicely to the return that I see in manifest investing. Remember, manifest numbers are coming from the analyst community, and I'm getting a par of about 14.5% from manifest. So I think that's my final slide, Mark, and I'd like to add a position in Alimentation Couche-Tarde.
You just love saying that.
I just like that company, yes.
Well, as you know, it's one that I meant to bring to the national convention a couple of years ago, and I balked, and I should have, because based on the slide that you've got here, it would have been right there.
Of course it would have been.
Well, Ken knows. Ken can back me up on this. He saw it. He wondered why I didn't do it that night. All right. Let's go ahead, and I'll take us first with some screening results. I love to look around outside the tracking portfolio. What I've done here is prepared a Sweet 16. These are going to be companies that have outstanding, superior quality rankings and return forecasts. These two columns here basically become that manifest ranking, and you can see these are the top 1% of all companies that we track. And what I've done is just kind of gone through and circled in red things which are less attractive to me. Relative strength index, that's just simply a momentum measure, and that means that they've been fairly hot. It's no surprise that Alphabet has actually been pretty hot here lately, but again, I'm searching for stuff very much like Hugh McManus will be talking about here in a few minutes. I love to find them before the momentum catches on. I like to get there before the momentum. And I also like to shop when they're down towards their 52-week lows. And again, that's what I'm looking for here, something down in the single digits or certainly something less than 20%. So it's trading fairly close to its 52-week low price. You can see that for comparison purposes, the value line low total return forecasts. You can see the return on owner's capital. We're going to go through these here in a minute. And basically, the analyst consensus is unanimous. That thinks that all these companies, the analyst consensus believes all of them are trading attractive relative to their fair value, the stock that they think is a normal and fair value for the company. And then you can see that there's quite a few fairly elevated one-year expectations for the companies on the list also. I'm zooming in on Limoneira. Limoneira, ticker symbol LMNR, because it meets all the criteria. I thought this was a South American fertilizer company, and it's not. So it just goes to show sometimes the things that you assume or believe to be true are not so true. Here's what it looks like on an SSG. This is a company that's been around for a while. We'll get into that in a minute. A little bit bumpy here. We'll talk about that also. You can see the bumpiness here, particularly in 2019 that's projected, but a fairly steady top line record. A little bumpiness here. We'll talk about what that comes from, but all in all, a fairly interesting company. This is what they do. They've been making lemons. These are lemon farmers. Lemons since 1893. Back in the days on the heels of the gold rush in California. So they have lemon groves in California. Again, dating back to the late 1800s. Now they do a few other citrus products. They do some avocados, but that is what the company is. They are basically a lemon farming producer. Here's the breakdown of the stuff that they do, just so you can underscore a little bit. 80% of their business comes from lemons, 5% from avocados, 7% from oranges, and then they've got specialty citrus for another 4% or so. And then they've got a tiny slice of their business we'll talk about in diversified operations like rental and real estate. But again, a fairly decent picture of fairly steady results over the years, and farming is not an easy field to be steady in. That's no pun intended. It's just not easy to remain that steady. You can see that some of their results have been a bit, you can call it engineered if you want. They've sold off shares of Calavo growers a few times in the past. They've sold off some real estate and that type of stuff, and those type of transactions have kind of smoothed things out a little bit when agriculture wasn't quite so smooth. They're basically a pillar with their operations predominantly in southwestern California. You can see up here, that's where the majority of their lemon production comes from, but they actually do have production facilities in Chile and Argentina, and they're expanding their efforts in Argentina as we speak. But you can see that it's a really neat study in diversification across the board, diversifying and basically having different climate profiles and geography from north to south, so that they have a steady production covering the seasonality of the business that they're in. So you can see this is a company that's got a fairly decent market share, but one that has been growing pretty strategically over the last several years. They've been buying up independent producers. They do have an eye for farmers that are getting up in the years and perhaps not continuing. If they see an opportunity where the farmer or the family is not likely to continue in the field, they do pursue that and do add acreage and growing potential to their company. Avocados is something that they've been doing more and more of. This is something that's been in the news quite a bit with the tariffs and everything else. Again, this is a fairly small slice of their business, but again, fairly bumpy, very weather dependent. They got hammered in 2018, 2019 production because of the really nasty weather trends that have been going on. But they do want to continue to grow and increase the amount of avocado production, and they're working steadily on that. They also produce a fair number of oranges. Oranges are actually a fairly big component of their overall profit picture. But again, this is another one that got hit fairly hard here with the adverse weather conditions, some of the fire situations in California, and a whole bunch of nasty stuff that happened in 2018, early 2019. You'll see analysts make an awful lot of diversification. That's the bad type of diversification that Peter Lynch talked about with companies where they've gotten into some real estate properties. But I think I can make an argument here that what they're doing is not the same thing. Again, what they're doing is taking relatively vacant, non-producing areas of their real estate that they have and turning it into structured, planned communities like we see all over California. And they do a real nice job. They've retained a company to take care of the details of that planned community. I would draw your attention to the fact that it is a tiny slice of their business, so no matter what happens, it's not catastrophic overall. But I think it's just strategic that they are taking some of those locations and turning them into interesting living quarters. A lot of the stuff they sell directly to their own employees, rental and sale. Another thing that they have is, we all know that water is such a strategic, critical asset to have and a resource to have. They do have secured water rights for a large amount of water, certainly enough water to take care of their needs, with the potential of selling some peak water off to other users of water, and again, just something they can monetize. So these are the types of things that they're being very strategic with, and going forward. 2019, why so sour? You can see that the growth here on the right-hand side of the graph is actually up in the mid to high teens. But they did take a really nasty hit in 2018, 2019. You can see it on the earnings chart there. And they would characterize it as a black swan. They've never seen anything like it in over 100 years of doing this, where all of the crops, the lemons, the oranges, the avocados, all got hit with kind of a worst case scenario, kind of a black swan situation, a once in 100-year thing, which we all know seems to happen every 10 years or so in various things. But one of the things that has actually led them down the path of is better diversification, this geo-diversification, working more to get their facilities spread out across Southern America and into North America. It's actually help them to strategically expand their capabilities, better use their distribution and packing facilities. Again, the real estate image on the lower left is the clubhouse for one of those planned communities. It's also basically helped them to build enough scale into their business that they are now one of the major customers of Walmart, providers to Walmart. Walmart, by the way, is the largest produce retailer in the world. They also provide a lot of lemonade to Chick-fil-A. We learned that Chick-fil-A, the highest margin element on their menu is the lemonade. They would love you to order the lemonade there. That's where Chick-fil-A makes the most money. Another thing that they've been forced into doing is they took a few hundred acres off to the side and they've actually started growing grapes. They will be producing wine also. So a lot of cool stuff going on. Just walking through some of the stuff up at the top of the chart, you see us put these things out. The relative strength index has been floating down into the 30 to 50 range. When you see us talk about a relative strength index down around 30, we love to see it down around 20. As you can see over here in the center of the chart, that means that the price point down here at the bottom of the chart is a fairly attractive, perhaps support floor underneath the stock, based on what's gone on in the past. Leaning on Irish Spring and Hugh McManus for a minute. Again, we like to buy stocks that are towards the low end of their range for the next year. With the stock price down in the 19 to 1950 range, they're relatively close to that 52-week low, closer to $18. And the analysts who follow the company project that it's possible their high target is $30 for the next year. So again, we like to see that 52-week position down towards the lower end of that range. Hugh loves to shop down in this zone of 20 or less. You'll hear him talk about that. Morningstar thinks the company is on sale. They think that the fair value of the company is approximately $21. You can see the $20.98 there. So when you see us talk about a company being on sale in the opinion of Morningstar, that's what we're talking about. That $19 compares pretty favorably to a price of nearly $21. So the company is theoretically on sale by 9 or 10%. The analyst consensus also agrees that the company is slightly on sale, if you want to think of it that way. And last but not least, you know that we've talked a lot about this owner's return on capital. I'm going to actually do an hour-long session on this, showing you the findings over the entire value line 1700. But what I'm finding is that it's a really kind of a fascinating audit or double check on stock selection guides. And it's kind of a fascinating double check almost on a side door to accommodate or actually keep track of the capital allocation, the capital structure, the capital strategy, because it accounts for the long-term debt in the calculation, something that we don't do much of on our traditional stock selection guides. We also keep track of the amount in the checkbook also. And in the case of the way that you might want to frame this is you can think about this very much like you think about a PAR. An owner's return on capital is very close to a projected annual return in terms of what it means and how it stacks up in the universe of companies. So again, we would be looking for something double digit, maybe something between 10 to 20%. And it's just something that we're going to go into in a lot more detail. I love the way that it accommodates and reflects the capital allocation on the company. So with that, I'm going to go ahead and add some lemonade to the roundtable portfolio. And like I say, I was surprised to find out what the company was about and kind of pleased to see that we have this opportunity with this Black Swan event to get in and have some fun. I look forward to seeing how this one does.
Mark, we have one question from the audience. Michael would like to know, is any of this fruit that they're growing organic, or is it just for the general market?
I don't know about the organic question. They kind of break things down into fresh, where they sell the entire citrus fruit, whether it's a lemon or an orange. And then they also do sell to the juiced version, the processed juice version. So I do not know the answer to that. I will check into that, organic or not. I suspect we're probably going to get back an answer that everything they do is organic. That would be my guess. Anything else?
No, we're up to date.
Okay. So with that, Kim has an opportunity she wants to describe. Since my company wasn't a fertilizer company, I guess she felt she had to come in and provide one. Take it away, Kim.
That's right. Absolutely. I don't have a whole lot of slides, guys. My computer and internet was going in and out all day, so I captured what I could fast. Mosaic is a company that provides potash and phosphate for crops for growing. They mine and process phosphate and potash for crop nutrients, and then they ship it where it needs to go. They have 3 potash mines in Canada and a couple in the U.S., and they're building a bigger one in Saskatchewan, which is where my mom's from, in Canada. As you can see here on the slide, this is from Yahoo, and today it was up 5.91%. 1-year target is 31.79, and I just think this is a commodity play. I own this through my other, I have 2 investment clubs I'm in. I own this through my other investment club, and its RSI is a little high right now. It might pull back a little bit, but let's go ahead and go to the next slide. Here it is, the overview of what Mosaic is. Next slide. When I go searching for stocks, I have a couple of places I go to, and I went to the Schwab site, and under research, then you look at stocks, you have the CFRA, which is S&P Global, SPGI, and they put out every day, they will have a 5-star list of what stocks they think are undervalued and where they feel that you can get great potential return over the next 12 months. On that list, I think they had like 40 different stocks, and Mosaic was on there. It was a 5-star since November 6th of 2018, but they put it on there when it was $35.29. Well, the 52-week low on this stock is like 20 bucks. So it kept on going down another $15. I have a little tendency to I might be putting an alert on some of these stocks as to what the price it was recommended, and when the price goes up, let's say 5% of when it was recommended, so I know that the momentum is going positive on the stock. Next slide. This is the value line that it's as of July the 5th, so it's very current. And to my surprise, I found that this is also a triple play that Mark talks about a lot. And I love triple plays because they're very profitable. As you can see, you want to have a stock that has a low PE relative to what it normally is. And right here, when the stock price was $24.16, and today it was at $25.21. So we're not too much different, but look at that trailing and median. So we really have a compressed PE ratio, and you want that stock price to go back up to normal levels. And if you can see, we're in the projection box on the value line. The low price that it could go to is $40, which would give us a 15% annual return, or a high of 55. That's really sweet. So we've got that, and we've got 2 of those things right there on our list, depressed stock price and the PEs. Can you go back up a minute, Mark? I like where Mark has got this circled here. Anytime on a value line sheet where you see the solid black line and then the dot, 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 and you're seeing the price bars of the stock price, and the dot there is below that, wake up, people. Recognize it. That is where a stock is undervalued. That's a great opportunity to make money. Okay, back to the next slide. Here we go. You can see where that projected PE going out is only 14. The average, I have found, it was like 22. So they've got a lot of room to run with that stock price. The little things as you go down looking at a value line, you can see that, you know, the cash flow per share is at $4.20 for this year, but it's going to go out to $6.65. They pay a little bit of a dividend. They have to use some money for their capital spending, but you know, look at that book value. That's a company that's got good management. It's keeping consistent or going up. But to go from $28.80 to $38.50, this is a cyclical company, and you can see where those numbers for the last, I don't know, 2010 all the way going up to 2017, 18, they were all not doing very much, but look at how much that's going to jump to $38. The revenues have steadily been increasing, and we were in this cyclical stage where it was going flat to going down, and now we're going back on up. And that's the part where you want to start getting back into the game, where in 2018, the revenues were 95.87, 98.50, 10.400, and all 12.50. There you go. And that margin, that operating margin is going up, and as well as that net profit margin. So the company and the management team is working diligently to keep this, to keep on going well. Next slide. One of the things that I like to always look is, since this is a commodity stock and it is on phosphate, I wanted to see where is the price of phosphate right now. Well, as you can see in 2017, the November, December, it was nice and flat at $80.22. But notice how ever since then, it's been going up and a nice, steady, even climb. And Mosaic is one of the largest producers of the finished phosphate product. So that's great for what the stock price can do for us, which is going on up because the commodity price of the phosphate is going up. Next slide. The potassium chloride, look at where we had our cyclicality, where end of 2016 all the way up to the beginning of 2019 this year. Look, flat as a pancake. Now, look at the momentum of that going straight on up. And they produce, have a capacity of 10.5 million tons of this product a year. So because the product itself is that the need for it and the commodity price is going up, I really feel that the stock price of Mosaic will go up also. Next slide. You can see where the stock price was going down, and you can see how the RSI was nice and low. Right now, we're getting higher highs, and we're getting, looks like we could be getting some higher lows. So the momentum of the stock is going up. We've got to watch where that RSI is 61.226. So we may have a little bit of a pullback, but I'm really expecting where the stock price going forward could be at $31 and going out, as the value line sheet says, it could get to a high price in 5 years to 55. That's a double. That's our 15% per year that we could get in return. Next slide.
Oh, that's it.
That's it. So short and sweet. I also circled on my value line that this company is likely to deliver strong cash flow generation for the full year, and they anticipate bottom line growth of just over 50% on a modest top line improvement. We've got Vanguard owns 10.4 and BlackRock is in it also. So I hope you would consider this a stock to add your portfolio and something to consider. Yes, it is a cyclical. Yes, it's a commodity. I know a lot of people like to avoid that, but it certainly looks like it's hit its bottom as of the end of May, and it's starting to go back up. Thank you.
Okay, thank you, Kim, and maybe we can figure out when to get out after making a significant gain.
Cha-ching!
All right, thanks, Kim. All right, Si, MKS Instruments.
All right, thanks. I will. I have a number of slides, but I'll try and go through them fairly quickly because this is, I will go ahead and say up front, is a bit of don't try and dig deep into the company's business and make your head swim. Simply understand it generally so that it makes sense to you and so that you can hold management's feet to the fire and then trust good management based on their record. I think that's very much a nutshell of the stock selection guide methodology anyway, and perhaps sometimes we overthink things. I know I have overthought my way into bad investments before. So tonight, our goal will be to get a quick handle on a business and determine whether it looks like something we want to add to the portfolio and then study for those of you at home. You could see that it's a fairly steady company. You can both on PE and margin, although it does have some cyclicality as both this chart and the next slide show. MKS Instruments is another photonics laser related company. I guess this is my year or couple of years to look at those companies with IPG Photonics, lately 2.6 and now MKS. And actually, I have one slide that has all three of those companies
Cool.
on it.
You're killing it with 2.6, by the way.
Later on, I was close to picking it again, but I didn't want y'all to start accusing me of new cognizance. So we figured I'd go with this. I'm not sure who picked this before because it is a one-time in the portfolio, as we'll see.
I did, Cy. This is Mark back in October 2018.
Oh, okay. All righty. And what caught my eye is, as you can see here, Value Line had a 17% low return, and then go ahead and go to the portfolio, Mark. I, too, was looking for something outside the portfolio. In fact, was looking at that ivory soap screen that Mark alluded to earlier when he did his Sweet 16 stuff, and I was looking at some of those companies, and there were some interesting ones here, but I settled on MKSI. Notice it's right in there with Cognizant in the portfolio as far as similar potential return. I like the quality, the strong financial strength of 80 or better, good growth with a reasonable PE to go along with the growth, and the fact that it was a one-time selection. Next slide. Again, here is my quick industry study. Manifest puts 2.6 in the same industry as MKS Instruments, and you notice that they are right next to each other in return in the company, in the industry, and they are the only two companies in the industry that are both excellent quality and in the sweet spot or even above our goal of 5+ MyPar. Next slide. Here's what the company says about itself. They don't get into a whole lot of specifics in this present. This is from their latest investor presentation on their website. They did report earnings after the market closed today. They did beat estimates by a little bit. So they will have a conference call. I'm not sure if it's scheduled tomorrow or a little later, probably tomorrow, but this is the latest presentation that's on the website. They say they're a global leader. They look for high growth markets. They try to be sustainable and profitable, and they try to be disciplined. Next slide. They've been around for over 50+ years, enabling technology by, as you can see, solving complex problems. You kind of get this theme, advanced products, solving complex problems. You get that theme in a lot of what they say. Next slide. Focusing on high growth markets. Their excuse me, their cyclicality comes from the fact that a significant chunk of their business is in the semiconductor industry. They provide testing equipment and process equipment for the semiconductor industry. All sorts of semiconductors, largely cell phone and touchscreen related semiconductors, but they do all sorts of semiconductors. You notice that their revenue is getting less dependent on that, getting more into some of the advanced processes in the laser and the photonics area. Next slide. Here is a very busy chart. Their point, I think, in this chart is the left-hand column are essentially companies that they compete with in some aspect of their product lines. And you can see MKS is at the top, and it shows where they rank as far as share of market in that particular product line that you really can't read on this particular slide, which are the two. But the point that I'm trying to make, and that I think they're really trying to make, is that they are ranked between first and third in all of these areas, and they have a broader portfolio than any of their competitors. I've highlighted IPG and 26 down there just to show you how their product lines compare with those two companies. Next slide. Here's what Value Line says about it. They put a little bit, the company's talking what you might call warm fuzzies and philosophical and goal-based description. Value Line tells you a little bit more about what they actually do. They are in the instruments business. They measure and analyze gases and other things related to semiconductor manufacturing. They have started producing instruments for fiber optics, as you can see, flat panel displays, gas lasers, and solar cells. And then the specific things they make are sexy products like pressure and flow measurement, gauges, injection systems, valves. We all love those sorts of things. As you can see, they're really a high-tech industrial core producer. They do gauges and instruments related to semiconductors and other technological products related to computers, cell phones, and the like. Next slide. Again, Value Line talks about, I'm not sure what this slide looks similar. I wonder if I duplicated it somewhere. But again, this is the products or what they are. They're a global producer of those things. Go ahead and next slide. I think that's a duplicate. Yep, I see what I did. I split it into two slides and apparently didn't delete the first one. All right, we've done these. Let's keep going. Mark had problems with the internet gremlins, and it sounded like Kim had some storm gremlins. I had an operator headspace gremlin apparently on that one. Then I jump back into the company's presentation. This is their management view of their finances. They, again, have a strong track record. They seek to deploy capital with R&D and the like to generate. It's interesting that they say they have a strong emphasis on generating strong organic growth, but they also have a strong mergers and acquisition strategy, which they also mention here. So they seek to buy up companies in related fields and then turn them into strong organic producers, not unlike what 26 has been doing for a number of years. And then they seek to improve their profitability. Next slide. Here's their graphical representation, 25% plus compound annual growth in revenues over the last 5 years. Their non-GAAP EPS, which primarily that takes out stock-based compensation and their acquisition-related expenses. For the non-GAAP, that's up 54% a year. Next slide. They've been paying a dividend for 8 years and steadily increasing it. It's not a huge part of their return, but again, a good confidence indicator that management believes in their business and their profitability, even though they are in a support role to a somewhat cyclical industry, that being the semiconductor industry. Next slide. And then they have a strong balance sheet, which is particularly important because of the fact that they use debt to generate and fund their acquisition. You can see here that they have cash for almost half of their debt. So their net debt's only $538 million, although their total debt is over $1 billion. But they have a lot of free cash flow that they're using to pay down the debt. Next slide. Then we get to my judgments. This is from the stock selection guide. I took a much more conservative view of sales than the manifest consensus. I basically pulled off of Value Line's 5-year projections and had sales growing about 7.5%, which is almost half of the manifest consensus. Profitability, net profit is about the same as manifest when you take into account the pre-tax margin and the taxes. And that gave me projected earnings per share of 9.6%, which interestingly is not that far off the Value Line projection, even though I'm a little different on profitability there. And next slide, we'll get to the PAR and the potential high total return using high PE. And notice, even though my sales growth, as I mentioned, was about half of manifest's projection, my PE is a little bit different than manifest was, and we end up coming out roughly the same place in a potential total return over the next 5 years of 14 to 15% if you use average PE, potentially as high as 20% on the upside if it hits the high PE. So I'm suggesting that we add $1,000 of MKSI.
Okay, we'll go ahead and double down on our position and leave the rest up to the audience. Thank you, Si. All right, we've been waiting for this one for a while. We love it when he was able to join us. He's not traveling tonight, so thank you for being able to be with us, Hugh, and we'd love to hear your thoughts on Ardelyx going forward.
Hey, I hope everyone can hear me all right. I spent a bit of time looking for a microphone. It's a huge Larry King-ish microphone, but it seems to have wandered off somewhere. I don't know where it's gone.
You sound pretty good to me. Is it okay with you, Ken?
Yes, the sound is a little hollow, but it's more than serviceable, Hugh.
Okay, well, I'll try and not be as hollow. Try and fix that. So I'm going to look at Ardelyx again, and as with many of the companies I look at, there is a method to this madness, but you're not going to find it sitting on a nice, neat SSG. I got excited when I heard a company was called Lemon, and then I discovered you could do an SSG, so that ruined it for me. But with these companies, you can't. You really have to get into the nuts and bolts and figure out what's going on with this company and whether or not it should survive. And for me, working in the biotech industry, this is useful. Most of the companies I work with are emerging companies, though do quite a bit of work with the traditional pharma companies. And having a background with these emerging companies, which really are doing the same sort of thing, but taking much more risk along the way, you learn about the clinical trial process, the indications that they look for, the do's and don'ts, etc. And you really have to dig into that in a way you wouldn't do to the same extent with an emerging company, where honestly I probably would just look at the numbers and would start to dig behind them. But with a company like Ardelyx, you really have to dig deep. Let's move on. I just have a few slides. I've cut off many of the slides that I had before about the background. I might just talk about them in passing. But the story hasn't changed. My thing is I'll add more shares to the portfolio if the story hasn't changed. I've always been doing that. buying what I already own. And if I can't find something, then I add something new. I love companies, as Mark pointed out, that are near a multi-week or, in this case, a multi-year low. Company, I love it when big company
Having a little bit of difficulty with the
just
sound.
happy. Reason there has to be nothing in the portfolio. Is it coming? Disappeared completely for a while when someone was talking. But all in all, I buy what I already own. Slide. So we move on to the next slide. I think it's 67 on this deck. I'm just going to talk about the biotech industry in general, but first, a quick recap of Ardelyx. It's a public company. It has a number of small molecules, like an aspirin, things that are small molecule. It's not a molecule that weighs less.
Oh, darn it.
Than what's called 500 grams. It's in
Hugh,
the gut.
excuse me, are you moving around? You're cutting in and out. We're getting very clear, and then suddenly it leaves us. Okay.
It could be the internet connection.
Okay. Well, why don't you start this slide over again then, Hugh, okay?
Can you hear me all right? I was just going to say, this is a public company. Naturally enough, if we're buying shares of the...
Now we're still getting some breakup.
Common stock. I should give up because I don't think it's going to improve. I think that I'm not suffering for... I've got the virus that Kim had earlier with an internet connection. Because I see the... indicator I'm looking at, the bars are going up and down for some reason.
Okay. Why don't you
Hope
just
it doesn't mean earthquake.
just give a quick summary of what you expect over the next couple of months, and then we'll just call it good.
Well, the drug is up for approval on the 12th of September. It will not have an advisory committee meeting. In other words, we won't get a public view of what's going on. FDA says it's not necessary, so that's not a bad thing at all. What I did was, in the slides, and they will be publicly available, I just showed why, in aggregate, there is not a lot, there is risk, but very high reward in investing in emerging pharmaceutical companies. And you look at the failure rate in the clinic, by the time you get to a drug that is, well, these slides just show that for every dollar that's invested, there's on average about a $14 to $15 return. It's really quite staggering. When things go wrong, they go wrong spectacularly. They drop to zero. Quick gander at the clinical trial process and the fact that there's about a 14% chance of a drug making it from phase 1 on, much smaller percent if it's a cancer drug, significantly higher if it's a vaccine or something to do with the eyes, ophthalmology. And orphan drugs, interestingly, have a much lower success rate than their non-orphan counterparts. But bottom line is that this drug has done well. It probably has about an 80% chance of getting through the FDA approval process. We will know in September whether or not it receives marketing approval. It's very unlikely to be declined entirely. If anything, they'll get a complete response letter if there's something inadequate in manufacturing, but we'll cross that bridge when we come to it. This company has a lot of cash. It's only burning through about 16 million a quarter. So it has enough cash to keep it going for about another 2+ years. So I would like to throw another Ardelyx log onto the fire. Sorry about the internet connection.
That's all right. Maybe we'll work on that and hope for better next time around. Thanks, Hugh. We appreciate it.
Yeah.
We really appreciate the shares that you brought to us under $2 back around Thanksgiving.
Oh, yeah.
I think that's the last time we accumulated, and I think a number of us actually made some personal, including Wendy and I actually did. We're hoping for another biotech stock paying for some more furniture in our house.
Oh, excellent.
All right, Ken, I think that's all for now on that. Oh, I was going to point out to the audience that if this thing does take off and erupt, irritable bowel syndrome being the nasty challenge that it is, the analysts actually have the potential for this company to go from 20 million in sales in 2020 up to 70 million in 2021. I'm sure that would help their cash flow considerably. When the next year's estimates come out, they're pretty robust right now. And with that, Ken, I think we can go to a poll.
Okay, I think I have the poll on the screen. Mark, I can't see the poll when I launch it. There it is right now. Okay, you all should see the 5 companies that we presented this evening. And we'd like you to vote on which one you'd like to add an audience position to. Normally we allow none of the above, but we're only allowed 5 choices, so you don't get to choose none of the above this time. We're going to ask you to commit.
What would we do if we had 20 candidates?
We couldn't do a poll on 20 candidates, Mark. Okay. Technology limits us to 5 choices.
All right. Well, CNN won't be happy about that. Wow. We have quite a horse race. That might be.
I'm going to give folks another 10 seconds or so. We'd like to get 90% voting. We're up to 81% voting right now. It doesn't cost you anything, folks. It just takes a little click of a mouse, or if you have a touch screen, just take your finger and touch the one you think you'd like to add to the portfolio. Maybe I can talk 3 or 4 more votes into coming in here, okay? I'm kind of counting to 10 in my head, and then I'm going to close the poll down. And let's close it, and let's share the results, okay? It looks like Alimentation Couche-Tarde has 29%, followed by Mosaic, Limoneira, and MKS pretty much in a dead heat at 18, 19, and 20%, and Ardelyx at 14%. So we will add another Alimentation Couche-Tarde to the portfolio along with my choice. And folks, I hope that you're going to signal the fact that I'm going to start having a few winners in what's going on, because I've certainly been a little bit cold in stock picking on the round table here for the last 6 or 7 months. So with that in mind, we have some questions. Mark, I think we go to our coming attractions. Mark and I will be in Oklahoma City on August 17th. You can go to the Oklahoma City, the Heart of Oklahoma is the name of their chapter. Go to their chapter webpage for details. Kim and Cy and myself will all be in Atlanta on August 24th. Again, the Atlanta Better Investing webpage for details. Mark and I are doing Mark is doing the Sacramento Investors Day on September 7th, and I think that's called Sacramento Area Chapter, so you can go to their webpage. Mark and I together are doing a cyber presentation to Portland on September 14th. Again, their webpage will give you further information. Cy is going to be in Charlotte in October. Mark and I are going to be out in Seattle in November. The Mid-Michigan Breakfast, the Stock Pickers Breakfast, is in November as well. Mark and I will be there. And then we have a date way in next April already in St. Louis. So if you'd like a visit from one of the nights of the round table, give us a holler. We'll see if we can fit you onto the calendar. And Mark, I'm going to start to deal with some of these questions right here, if that's okay with you, unless you have somebody to talk about.
No, go ahead and ferret them out. We do have interest from a number of other locations that we're going to be figuring out, including Kansas, John Kimmel and his fans out in Kansas. So we'll be looking at doing that too here fairly soon, along with some opportunities out in the Northeast again sometime in the not too distant future.
So is Kansas a car ride, Mark?
I don't know yet. We need to figure that one out.
Okay, the last time I rode with you in a car through the Midwest, it just seemed that we rode for about 7 weeks through that flat land, but maybe
somewhere out there they've got the largest ball of yarn in the world or something like that.
Joe says that his local library has had trouble receiving Value Line. Am I alone? Joe, you're not alone.
No,
there have been all kinds of complaints from up here in Michigan. Value Line has been wonky, to say the least, for the last 2 or 3 weeks. We're still getting messages to Diane. We have no idea who Diane is, but when we log on in our library, it starts out by saying, "Welcome, Diane," and then we have to press a button to go to what's actually happening. Mark, you were having Value Line problems as well, weren't you?
Yeah, and what I've found is you can kind of brute force your way through them sometimes. Probably something weak. I'm actually going to attend a Value Line webcast tomorrow, and I might get a chance to talk to Ian a little bit, and maybe get some idea how soon they think this stuff will be fixed.
Okay. Michael would like to know, Kim, do you know what causes the cost of phosphates to move up and down?
It's kind of like supply and demand, and right now, from what I've read, there hasn't been very much phosphate around, so that's why the price is going up. There's been very little supply, so the demand is going up. I mean, I think it's like anything else. Are the farmers choosing to spend money on the crops for that, and then is there enough commodity out there? Because that's why they're building a brand new plant out in Saskatchewan, to have enough, be able to develop enough product.
I can add actually a little bit of background to that too. I learned just recently, one of my friends is a fairly prominent farmer in northwestern Illinois, and for the first time in distant memory, they actually used their crop insurance. What that means is they gave up because of the flooding and all the bad, nasty weather and stuff, and collected on the crop insurance. And what that does is it throws suppliers like phosphate and potash suppliers into a tizzy, because obviously that messes up the demand side of that equation.
Thank you, Kim. Thank you, Mark. We're getting a lot of comments about Value Line. And all I can say is that if your library thinks it's their problem, and that's originally what our library system thought, that it was a problem they were having with their own servers, then your library system should be encouraged to contact Value Line directly, because it indeed is not a problem at the local library level. It's a problem with Value Line itself. We're getting a lot of folks telling us that for the last day or two it's been working fine. I can tell you that up here in mid-Michigan, a couple of our library systems are still having issues with what's coming from Value Line, but eventually they're trying to get it fixed. They do know that the problem is there, and we just hope that eventually they can get something going. Like to thank those of you that are congratulating the round table on our birthday today. This is our 9th birthday, so we're starting on the first month of year 10 next month, and we will be on the last Tuesday of August, so put it on your calendar right now if you can. I'm looking at other questions. Hugh, Debbie would like you to comment on SUPN if you have anything you could say about it.
What's the name of the company? I'm not familiar with the stock symbol.
I was trying to duck that as well, Hugh. I don't know what it is. Debbie, Debbie, can you tell it? Go on, Mark.
It's Supernus, if that means anything.
Oh, yeah. I haven't really followed it in great detail. Is there a specific question on the company itself?
Debbie, maybe you could jot us a question about what you'd like Hugh to speak about. And while I'm waiting for Debbie to type her question in, Michael would like to know, would we ever think of taking off half of a position of something for a stock that's really overvalued, as Simulations Plus appears to be right now with its negative forward potential? Would we ever consider taking just selling half of it rather than the whole position? Mark, Si, anybody want to take that?
Well, I don't know what we would do from a model portfolio demonstration view. I think that is not an unrealistic way of approaching things, and I have sometimes done that in my personal portfolios in the past when it is a valuation related sell, particularly one that is momentum driven, because I say, well, I'm going to take some of what the market's giving me, and I'll try and catch a little bit more momentum. What I would look at a little bit more seriously, and I think there's been some discussion on the roundtable about this. Those of you who have followed me for a long time know I speak very negatively of stop loss orders. I don't believe in them. The one place that I might agree with using them, I've not yet done it myself, but at least theoretically they make sense, is again a momentum driven overvalued stock putting in a trailing stop loss, basically saying I'm willing to give up 10% of the gain or whatever for the potential of the momentum continuing to go up. So I think that's not a bad approach, although again, by and large, I think it's best to make a sell decision and stick with it, which is kind of why I lean toward the potential trailing stop loss.
Anybody else want to comment on that?
We basically
Mark,
do
what?
that. We do that with Simulations Plus a little bit tonight with me stepping back. In fact, I wondered if it might be interesting to try and experiment, Ken, if you're up for it. You know, the audience also was one of that three-way selection of SLP going back along with Si. Si said he's going to write it out. I wonder what the audience would like to do. Would it be possible maybe to do a show of hands on a yes or no?
Whoa, no, it wouldn't.
Well,
no.
maybe we set up for that, or we poll online or something. It'd be interesting to see what the audience's opinion is on selling a partial stake in SLP.
No, actually, Si said I had no problem with selling it, but similarly, I'm not overly concerned with buying or with holding it. But no, I didn't have a problem with selling.
And I second the trailing stop also. I'm not a great fan of them, but this is a situation where I think it applies.
Okay, Mark, I cannot, once we've begun recording, I cannot move another poll into the webinar, and if I can, I don't know how. So, okay.
Well, that's
well,
brute force.
Well, why don't just for fun, why don't we do the experiment and sell 2/3? And since the audience tonight is silent, we will respect their silence and keep it.
Okay, and then we'll give them the chance to exit the portfolio by a vote next month.
Yeah.
Okay. Debbie has come back with her question, Hugh, and she thought that she had heard that there was something to be announced in clinical trials about this stock sometime in July. Have you heard anything about an announcement of clinical trial results?
No, it's well worth checking on the website. If you look when this company has filed, if it's an approval thing, just add 12 months to the filing date, and that's when it should be approved by FDA. But I haven't heard anything on clinical trials. I do know the company because I know a guy called Jeff Bozek who works there is a specialty pharmaceutical company, which is a little bit different. They take drugs that are off patent and reformulate them in some manner. And that often reduces the risk. And they also file through what's called a 505(b)(2) process. And under that process, the burden of clinical trials is lowered substantially. And in fact, there are many examples where companies can file without having to do a clinical trial at all. And in fact, there are examples not only where they don't have to file a clinical, perform clinical trials, but they don't even have to rely on clinical trials performed by the originator. And I can think of an example where caffeine was approved as a drug and given 7 years of exclusivity by the FDA. It was presumed to be safe and effective. But yeah, it's a low-risk company. It's not a company that I typically would do business with, being a specialty pharmaceutical company. But it is, I'm sure, an interesting company. And I haven't heard anything about any clinical trials that it might be. I will look it up.
Thank you, Hugh. We might be getting some information. Margot has her hand up. And Margot, I'm unmuting you, or I'm attempting to unmute you. Margot, you might be muted on your side because I'm not able to unmute you here. Margot, you have to unmute yourself. I'm coming up with that you're self-muted, so you have to unmute yourself. Pat, I have you trying to raise your hand. And Pat, you're unmuted. Go ahead and speak.
Regarding Mosaic, I live in Florida, and they're considered a big polluter. I wouldn't buy that stock for that reason. There's a lot of controversy involved with Mosaic hurting the environment in a very serious way.
Okay, thank you, Pat, for that information. Pat, I'm going to put you back on mute, and I'm going to take your hand down. And other than that, I don't have anything left. I'm going to check the question box once more. Question box is empty. The there's no hands raised. So with that, we'd like to thank you all for coming out on this warm summer evening to listen to the roundtable. And as we start our 10th year, I for one, Mark, am going to say publicly that I really never thought it would last this long. So thank you so much to you guys, including Kim and including the rest of our guests that have helped us do this through cold weather and warm weather, through up and down and earthquakes and hurricanes and everything else. We really appreciate your assistance and your presentations. And without your help, we never could have made it this far for this long. Thank you to everybody, and a special thanks to our audience, because without an audience, this would not be a lot of fun at all.
We'd be just talking to ourselves.
Yeah.
Okay. We're getting some questions about how many people attend, and the attendance goes anywhere from 150 to as many as 350. It just depends on the month and what else is going on. Tonight we were up near 200 tonight. So we're at one point we got almost to 200. We never quite made it tonight. So again, thank you everybody, and I'm going to close everything down if there's no other questions, and I'm looking, we don't have any. So good night, everybody. Thanks for being here tonight. Thanks for helping.
Stay safe.
Good night.
Good night, everybody.
Good night.
All right.